The global silver market is entering a phase that may fundamentally alter how the metal is priced, sourced, and valued. What initially appears to be a routine industrial procurement decision by Samsung is, upon closer inspection, a signal of far deeper structural stress within the silver supply chain. Combined with persistent multi-year supply deficits, record-breaking industrial demand, and growing strain in paper futures markets, this development suggests that silver is no longer operating within a normal commodity cycle. As of December 20th, 2025, silver is trading near all-time highs after decisively breaking through the long-standing 50 resistance level that had capped prices for approximately 45 years. Market reports indicate the metal is up roughly 77% year to date, a performance that already places it among the strongest performing commodities globally. However, unlike prior rallies driven primarily by inflation fears or speculative investment flows, this move is being fueled by tangible changes in physical demand and supply behavior. At the center of this shift is Samsung. According to newly surfaced documents, Samsung C&T, the conglomerate's trading arm, entered into a $7 million offtake financing agreement with Silverstorm Mining to restart the La Perla silver mine in Durango, Mexico. In exchange, Samsung secured rights to approximately 7 million ounces of silver concentrate over a 2-year period, paying roughly $1 per ounce upfront. In absolute terms, $7 million is immaterial for a company of Samsung's size. Strategically, however, the implications are substantial. Rather than sourcing silver through traditional commodity exchanges, Samsung executives reportedly traveled directly to Mexico to secure supply at the mine level. This deliberate bypassing of conventional markets indicates an urgency that suggests foreknowledge of tightening supply conditions. Such behavior is not characteristic of companies that expect abundant, liquid supply at predictable prices. Instead, it reflects a growing recognition among large industrial consumers that access to physical silver is becoming increasingly uncertain. Samsung's actions are closely tied to its development of next-generation solid-state battery technology. These batteries, which promise electric vehicle ranges of up to 600 miles and charging times as short as 9 minutes, require substantially more silver than conventional lithium-ion batteries. Each cell reportedly uses up to 5 grams of silver, and a typical EV battery pack contains around 200 cells. This implies potential silver usage of approximately 1 kilogram per vehicle. Global vehicle production currently stands at roughly 80 million units annually. If even 20% of those vehicles adopt Samsung's solid-state batteries by 2027, annual silver demand from this single application could reach approximately 16,000 metric tons. For context, total global silver production is estimated at about 25,000 metric tons per year. This means that one technological shift, driven by a single major manufacturer, could theoretically absorb close to 2/3 of the world's annual silver supply. This figure does not account for existing industrial uses, including solar energy, electronics, and medical applications. Crucially, this surge in potential demand is occurring against a backdrop of sustained supply shortages. According to the Silver Institute and multiple industry analyses, the silver market is now in its 5th consecutive year of supply deficits. Since 2021, cumulative deficits are estimated at approximately 820 million ounces, an amount equivalent to an entire year of global mine production. These deficits are not theoretical. They represent physical silver that has already been consumed without being fully replaced by new supply. Unlike paper contracts, physical shortages compound over time, gradually eroding available inventories and increasing vulnerability to supply shocks. That vulnerability became visible on November 27, 2025, when the Chicago Mercantile Exchange experienced what was officially described as a technical glitch that froze silver pricing screens during a critical trading window. The halt occurred precisely as Asian markets transitioned into London trading, and London into New York, typically a period of peak liquidity. According to insider reports referenced in the script, an authorized participant linked to Chinese flows stood for delivery of approximately 400 million ounces of silver. This quantity exceeds the entire available float of physical silver in London. The request effectively challenged the paper futures system to deliver metal that did not exist in sufficient quantity. While futures trading was halted, physical silver continued to change hands. Dealers raised premiums and industrial buyers scrambled to secure supply. The episode served as a stark illustration of the growing disconnect between paper silver markets and physical availability. Samsung does not control global silver reserves, nor does it own significant mining assets. However, its strategy represents a different and arguably more powerful form of influence. By moving upstream and locking in future production through offtake agreements, Samsung is effectively removing silver from the open market before it is even mined. This approach is not unique. China has reportedly been securing similar agreements with miners worldwide. When large industrial consumers bypass exchanges and contract directly with producers, the result is a shrinking pool of freely tradable silver. This dynamic does not require monopoly control to impact prices. It simply reduces liquidity for everyone else. Compounding this issue is the fact that approximately 70% of silver is produced as a byproduct of mining for other metals such as copper, lead, and zinc. As a result, silver supply cannot be rapidly increased in response to higher prices. Even a doubling of silver prices would not immediately generate proportionate increases in production. Forecasts for silver prices vary widely, but several respected analysts cited in the script outline a plausible path toward $300 per ounce under conditions of sustained supply stress and rising investment demand. Mike Maloney has suggested that a tenfold increase from current levels is entirely possible, citing historical precedent and the likelihood of renewed monetary demand once gold becomes prohibitively expensive for many investors. Peter Krauth has projected $95 silver within 12 to 24 months and argues that a decisive break above 50 opens the door to $100 and beyond. Central to these projections is the gold-silver ratio, which historically averages between 61 and 71. In 2025, despite silver's rally, the ratio has hovered around 79.1 and was as high as 104.1 earlier in the year. If gold rises toward $5,000 and the ratio compresses toward its historical lows near 15:1, as it did in 1980, silver prices mathematically approach $303 per ounce. Historically, such compressions have occurred rapidly rather than gradually. Previous silver bull markets saw explosive price moves over relatively short timeframes. Unlike gold, silver's demand profile includes a substantial and growing industrial component. Industrial fabrication reached a record 680.5 million ounces in 2024 and is forecast to exceed 700 million ounces in 2025. Solar panels alone consume over 200 million ounces annually, representing roughly a quarter of primary silver supply. Industrial users are largely price inelastic in the short term. Manufacturers cannot easily substitute away from silver without redesigning products, a process that takes years. This creates a rising price floor, ensuring persistent demand even during periods of reduced investment interest. The script appropriately acknowledges counter-arguments. Some analysts believe $300 silver would require an extraordinary supply shock or a major financial crisis. Others highlight the risk of technological substitution if prices rise too quickly. Silver's volatility also presents challenges, particularly for mining equities, which can experience sharp swings. These risks do not invalidate the bullish thesis, but underscore the importance of understanding silver as a high volatility asset class. Taken together, the evidence presented points toward a structural bull market driven by physical constraints rather than speculative excess. Mine supply peaked in 2016 and has declined since, while new projects require 10 to 15 years to develop. Meanwhile, industrial demand is accelerating, not slowing. Samsung's move does not single-handedly control the silver market, but it exposes a reality that has been building for years. Silver is becoming too important and too scarce to be left entirely to paper markets. Whether prices ultimately reach $70, $100, or $300, the direction of travel is clear. The silver market is no longer governed by abundance, it is governed by access,